You wake up tomorrow, bank account at zero, no portfolio, no safety net, just you and everything you know about money. Most people would panic. I'd call it the greatest opportunity of my life. Because here's what nobody tells you about starting over. It's not about what you have. It's about what you do next. Let me take you back to when I made my first investment. I didn't have a blueprint. I had YouTube rabbit holes at 2 a.m., random stock tips from strangers on the internet, and a whole lot of hope that something would stick. Years vanished while I figured out what actually works. So let's cut through the noise. If I'm rebuilding from ground zero in 2026, here's the exact playbook I'd follow. No fluff, no theory, just action. You've scraped together $1,200. That's your starting line. Now you've got a choice. Save it or invest it. Here's what that choice really means. Inflation sits at around 3% heading into 2026. Your monthly expenses of $3,400, they'll creep up to $3,500 by this time next year. Stash that $1,200 under your mattress, and 12 months from now, you'll still have $1,200. But that $4 coffee in January, it's $4.12 in December. Your money hasn't moved, but its value has. That's not saving. That's slow-motion loss. Put it in a high-yield savings account, they say. Sure, you'll earn 4 to 5% interest. Your $1,200 becomes $1,254 by year's end. Better than losing to inflation, right? Here's the problem. You're still playing small. When you park money in a bank, they pay you interest because they're using your cash to make loans. You're a passive participant in someone else's profit machine. When you invest, you become an owner. You're buying a piece of businesses that are fighting to grow, innovate, and dominate their markets. When they win, you win. Let's talk about Apple. Buy one share back in 2010 for roughly $10. Hold it until today. That share is worth over $200, and that's before counting dividends. That's a 20x return. That's what long-term investing can do that saving never will. The stock market has delivered 7 to 10% annual returns over the long haul, even through crashes, recessions, and chaos. Saving protects you from inflation. Investing builds wealth. Not every company is Apple. Remember Palm? They made smartphones before smartphones were cool. Big investors believed in them. Bono dropped $460 million into the company. But Palm couldn't compete with Apple and Samsung. By 2010, HP bought them for $1.2 billion, a fraction of what early investors expected. Within years, the brand disappeared completely. Here's what I learned the hard way. Putting all your money into one company is gambling, not investing. One bad pick and you're done. That's when I discovered ETFs, exchange-traded funds. Think of an ETF as a basket. Instead of buying one apple, you're buying the whole fruit stand. Take SPYM, which tracks the S&P 500. That's 500 of the largest companies in America. Apple, Microsoft, Amazon, and 497 others, all in one investment. Two things happen when you buy an ETF. First, your risk drops dramatically. You're not betting on one horse. You've got the whole stable. Second, you save time. No need to research hundreds of companies or monitor earnings reports every quarter. Popular ETFs include VOO, SPY, IVV, and QQQ. For beginners, stick with something that tracks the S&P 500. Broad exposure, proven track record, steady growth. If I'm making my first move today, I'm going with SPYM or QQQM. I like the tech-heavy focus of the NASDAQ 100. You know what to buy. Now the question is when and how much. Two situations where I'd pump the brakes before investing. High-interest debt. Say you charge your wedding on a credit card. Now you owe $5,000 at 23% interest. Every month, you're paying $95 just in interest fees. Money that vanishes into thin air. If you've got an extra $1,200, throw it at that debt. Debt is a slow leak in your tire. You can keep pumping it up, but you're never getting anywhere until you patch the hole. no emergency fund. When you invest, you're locking that money away for 5 to 10 years minimum. If your laptop dies and you need $800 for a replacement, you don't want to sell investments to cover it. Build an emergency fund first, 3 to 6 months of expenses in a high-yield savings account. Money that keeps pace with inflation but stays liquid when life happens. Once you've handled debt and built that cushion, you're ready. You don't need $1,200 to begin. You don't need $500 or even $100. Many platforms let you start with $1. But here's the math that matters. Invest $1 per month for 40 years at 10% average annual returns. You'll have $5,300. Bump it to $10 per month, that's $53,000. Scale to $1,000 per month, that's $5.3 million. Start with what you have. As your income grows, your investments grow, and eventually, compound growth takes over. Here's the step-by-step. Step 1. Open a brokerage account. This is your gateway to buying ETFs, stocks, and bonds. I use Fidelity. Head to their website, click Open an Account, and fill in your details: name, address, social security number. They need this for identity verification and IRS tax reporting. Step 2. Choose your account type. You've got two main options: Roth IRA, contributions grow tax-free. Withdraw at 59.5 with zero taxes and zero penalties. For 2026, you can contribute up to $7,500 if you're under 50, $8,600 if you're over 50. Taxable brokerage account. No contribution limits. Withdraw anytime. The trade-off? You pay taxes on profits and dividends. I'm opening a Roth IRA. Tax-free growth over decades is too good to pass up. Step 3. Link your bank and deposit funds. Think of the Roth IRA as your shopping cart. The ETFs are what you're putting in it. Step 4. Search for your ETF. I'm going with SPYM, trading around $80 per share. I'll invest $1,000 this month, but to keep it simple, let's say I'm buying one share. Step 5. Execute the trade. Click Buy, select market order to purchase at the current price, review, and hit Submit. Done. First investment complete in under 5 minutes. Now that you've made your first move, here's how to stay on track. Rule 1. Automate your investing. Pay yourself first. Set up a recurring transfer, monthly, bi-weekly, whatever works. This isn't about willpower, it's about systems. Automate it and forget it. Rule 2. Don't sell when the market dips. Look at 2020. Pandemic hits. Markets crash. Panic sellers locked in losses. Those who held on, they rode the recovery to all-time highs within 2 years. ETFs hold hundreds of companies. When one struggles, others balance it out. Stay invested through the turbulence. Rule 3. Stop trying to time the market. Remember the Costanza strategy? Investors who bought at the worst times, when stocks were high, still came out ahead long-term because they stayed consistent. Nobody can predict the market. The only thing you control is consistency. If you follow this blueprint, you'll start investing earlier and smarter than I ever did. If I could rewind, I'd invest far more aggressively from day one. But I can't rewind. What I can do is hand you the playbook that took me years to build. You don't need to figure this out alone. Here's what happens next. Join the Wealth Unfiltered Beginners Investing Masterclass. I'm walking through every single step. Opening accounts, choosing investments, building a strategy that actually works. The link is in the description. Don't spend the next 5 years guessing. Take action today. Because the best time to start investing was yesterday. The second best time is right now.